Hello, very good evening to all of you. How are you today? So, first of all, thank you so much for coming to our webinar, Master Fundamental Analysis, together with our seasoned investor today. So, this webinar is made possible because of the generous sponsorship from Bursa Malaysia, and because they are willing to invest in it, so we have it. Now today I've invited a seasoned investor with 26 years of experience investing in the stock market, including Bursa Malaysia, to share with you how he used his techniques and his KPI in value investing, how he interprets financial statements, and how he set his KPI in screening out bad trades and finding good trades. Now, before I continue further, I want to do a sound check. Now, you have a control panel on your right, I assume. So if you can hear me, can you please click the control panel, raise your hand button? If you can hear me, can you please click raise your hand? Okay. All right. Carol T, can you hear me? Jason Jin, Jason Fu, can you hear me? Ken Lau, can you hear me? Please raise your hand. All right. Since most of you have raised your hand, thank you very much. You can put down your hands. Thank you. Now today we will talk about value investing. But for me to have, I think for me to have a successful and smooth internet connectivity, I would actually want to turn off my webcam. But PC, you can remain a webcam. So I would just, if you would excuse me, I would just turn off my webcam. But this is definitely a live session, right? Just want to ensure that we have a smooth internet connectivity and bandwidth for the uh, the webinar. Okay, so today and over the past 4 webinars, we had an introduction to the stock market. We have a master the game of stock, understanding market indices and sector. And today we'll be talking about master fundamental analysis in value investing. And moving forward in the next 2 webinars, we will be talking about basic technical analysis. And then the last webinar, we will talk about choosing the right investment strategies based on fundamental and technical as well. So today we are on the 4th sessions. It is the first webinar for 2016, and I'm glad that you all are here today. So let me briefly introduce a little bit about our speaker today. He graduated from National University of Singapore in 1989. He has more than 26 years of working experience with several public listed companies and multinational companies. He is an author of Invest in Foreign Shares book, which reached popular top 10 best sellers books in August 2014, and he's also author of Invest in REITs. Now, he has been invited on several occasions to speak on Bursa platform and in other investment forums, and today we are very pleased that he's managed to spend some time with us today. He's also a full-time investor and author and trainer, and been investing in the Bursa market, international market since 1995. Now, ladies and gentlemen, please help me to welcome Mr. PC Wong. Now, PC, I pass over to you.
Okay, a very good evening to all of you all, and thank you, Chun Sen.
Yeah.
So let's talk about mastering the fundamental analysis in value investing. I think we will look at several topics here. First and foremost is what is value investing, learn the basics of fundamental analysis, learn to source financial information, learn to interpret financial statements, learn to understand key financial ratios and key KPIs to adopt, and build a KPI matrix. So let me share with you a philosophy based on the Invest in REITs book, which I've written, which I state that in any investment, study the facts, for they will lead to a logical conclusion. But keep your emotions in check, for they will lead you to many illogical decisions. So a lot of it must be driven by facts and not so much as sentiment, because when you let sentiment rule in your investment game, you will tend to make a lot of illogical decisions. Now, let's talk about what is value investing. It is based on the ideas taught by Ben Graham and David Dodd in the Columbia Business School in 1928. But I think most of us remember the icon of value investment is none other than Warren Buffett. But what does it mean actually? It means finding an undervalued company with growth potential which pays good dividends and holding on to your investment in this company until the market realizes its true value. From there, you can decide when you want to exit with a profit gain. So it means discovering a company that versus the peers in the industry, it is considered undervalued. But this company also has with it a strong potential for growth and preferably with steady dividend payment, because while holding on to the company, it is only logical that as you bide for your time, okay, there must be some dividend payment for you to keep on holding to your investment. But how do you find an undervalued company? Now, the key to all this lies in fundamental analysis. Now, I'm going to share with you why value investing can yield good profit over the long term. Now, this is an example from Dialog, okay, which since 1999 to the present, is almost 20 years, it has a compounded annual growth of 33%. Now, imagine if you were to, sometimes when we invest, we make that few percentage and we exit out, then further, sometimes we trade, we could actually make a loss. So overall in the year, we could wind up with a loss or with a profit that may be lesser than 33%. Of course, there could be some that makes a lot of money too. But on the average, if you have a good company and you hold on over a longer period, you can actually have a very, very good return. Now, 33% return annually is ranked among the best, that you have among fund managers and so forth. So that's why, you can actually identify a good company, hold on to it, watch it grow, to investing. The basics of fundamental analysis, first and foremost, you require performance report and also keep track of announcements which can impact the company, such as a resignation of a key person or new acquisition or project. So this the quarterly report comes out, you must read it, you must assess it, okay? How is the company? And in between the quarterly reports, look out for announcements which can impact a company. Use in order for you to keep track of the company that you are in. Number one is perseverance, an inquisitive mind, discipline, and most of all, you must be a financial detective. If you leave it to the news that comes out later, let's say tomorrow, okay, or over the weekend, then you would have missed the opportunity to assess a company as and when the news comes out. So that's why you need to be, you need to have an inquisitive mind, and you need to be disciplined in a sense that you will not, slow down in your determination. Because there you have whatever the company announcement are made, their quarterly report, and all those. The other secondary source, you can actually go to the company's website. Now, the company's website, sometimes you have some very interesting articles such as corporate presentations and so but when you read this kind of reports, you must exercise your own due diligence. The analysts do not have you it's not to help you make money. Only you can help yourself make money. Okay? Because analysts, sometimes they have certain things that is different from what you look at. For example, first and foremost, a tolerance for risk. Sometimes analysts may rate a company buy because they are more tolerant towards risk. But you are actually intolerant towards risk. Okay, you want to have a safer investment risk profile. So when you follow an analyst and buy into it, when certain disruption occurs, then you will panic very easily, and therefore you will sell. Okay, so that's why whatever you invest in must meet your own risk profile, and that is why, you know, later on we discuss about KPI as a risk management tool for you. Okay, always source your own information online instead of reading it from the newspaper, because online news happen there and then. Announcement comes in there and then. Whatever that is announced on the next day, you could rightly miss a boat. For example, the news comes out on Friday, okay, via an announcement in Bursa. But if you read it on the news on Saturday and you cannot trade, then by Monday you would announcement. You must be a financial detective yourself so that you can be a better investor. So something about using the Bursa Malaysia website. Okay, now if you want to read about company announcement, you go under the listed company icon here, then announcement, then you can actually click on whether it's financial result or other type of announcement. But here we will go for financial announcement, financial results. And here I've selected dialogue group as an example. Now before I continue, I wish to declare that I do not own any dialogue shares. Okay, so this is not a promotion. This is not a promotion study webinar. Then the other alternative, you can go onto the company's own website. Okay, under investor relations, whatever news, whether financial, that relates to the company performance is services, core business, things like this when you want to understand what a company does. Okay, if you go into the investor relations, you will have a list of reports. And here we are very interested in knowing the quarterly report. Now, always make a habit to read corporate presentation, okay, when there is normally a company that has high following of institutional investors, they would normally have a corporate presentation. So when you are researching for companies, one of my key choices is actually, you know, companies which actually does corporate presentation to institutional investors, because it means that they are the target of institutional investors for investment. Then this kind of companies would normally have institutional support. But if you go for a company that is small cap, micro cap, or even medium cap, but does not have a corporate presentation, it means that they are less likely being followed by institutional investors. Okay, so companies which does corporate presentation normally are in the eye of the they are in the interest of the institutional investors. Okay, they have interest in such companies. So let's look at analyst recommendation and how you can actually search for this kind of information. For example, okay, or you can use Google search. Then you just type in this dialogue group analyst recommendation. Okay, once you type in as a search word, then you will have a list of analyst recommendation. Here is one such from one website, marketwatch.com. Then you can see below here there are current rating, 6 bar 1 month ago and 3 months ago, you can actually have an indication of what other analysts are saying. So this is something which lends support, in your consideration whether this should be an investment. Okay, here we have the income statement. It is always very important for you to note the following: revenue, okay, profit for the period, okay, and basic earning per ordinary share, the EPS. Now, I won't always look at things like the finance costs, operating other expenses, operating expenses, and so on and so forth, because if, let's say, there's growth, okay, in the EPS, in the net profit, and in the revenue, other issues becomes secondary, and this will counter-check. I will counter-check with the balance sheet afterwards. But on the income statement basis, if you look at it, okay, over here, there's no great discrepancy. Okay, it's 479 million versus 483 million. There's no clear discrepancy here. Okay, then if let's say there's a sudden increase, I will look into it. But on the surface, it's okay by me. Okay, so on the other hand, increase almost 50%. But then you look at it as a percentage of the revenue, it's also very small. So that's why sometimes when you interpret financial statement, you need not go into too much of a detail. Okay, certain information would already show you that, compared to previous year, yes, it does look high. That's actually about 50%. But then compared to the revenue, it's actually higher than last year. Revenue is lower than last year. So this immediately tells me about one thing, okay, that despite the lower revenue, its profit was actually higher, and therefore the EPS too is higher. The other statement is actually the balance. Is actually the total current assets, the trade and other receivables, cash and equivalent. Because it can actually show the whether a company has any shortfall, okay, in terms. Then there is the current asset, as in cash and cash equivalent. Okay, here again you see that there's not much of a difference. It's just only about 12 million or so. Okay. So this is the second part of the balance sheet. You have equity and liabilities. Now, over here on the liability side, I'll be concerned about total current liabilities, trade and other payables, total liabilities, equity, and net asset per share. Okay, so over here, where you look at the total equity is here. Okay, total equity is now for current liabilities, I'll be interested in borrowings, okay. Non-current liabilities, also in terms of borrowings, okay. So over here, we know that total borrowing is almost to measure the kind of leverage, all this will fall into place. So it has a total liability of 1.5 billion here. And then again, you look at it, there's not much of a difference compared to the previous year. I mean, the last time the balance sheet was calculated, not the previous year, sorry, in June 2015. So there's not much of a great variance, okay? And over here, borrowings actually increased, but on this side, current borrowings fell. Will become clearer. Now, income statement gauges. We need to know that it is revenue growth, net profit growth, and EPS growth. Now, all this would show how the company is performing, and normally it is way against the previous year. Okay, so how we calculate it? It is revenue in current year minus revenue in previous year divided by revenue in previous year times 100%. And this one will give you the revenue growth in terms of percentage. Net profit growth is also the same. Current year minus previous year divided by previous year would again give you the percentage in terms of profit growth. EPS growth is also the same formula. Now, in analyzing Dialog's income statement, we have a revenue growth, okay, that is negative. So revenue didn't grow, but fell 0.96%. However, net profit growth was 19.9%, while EPS gained 15.7%. After calculating, we know the revenue growth, net profit growth, and EPS growth. Now, if you refer to the income statement, Dialog saw gains in its other operating income and share of profit from joint ventures, rising 321% and 122% respectively in 2015 versus 2014. So we go back to here. Do you see this? Other operating income, okay, joint venture versus the previous year. So actually, these are things that is worth noting. So from here, we can see that this is a plus point for Dialog, as it has multiple income streams to help it offset weakness in some other sectors. So when a company has multiple income streams, it actually helps the company in an environment where it's very, very challenging, such as Dialog being in the oil industry, saw oil price dropping now to almost US $30 per barrel. And in such an instance, okay, having multiple income streams does help. Especially in Dialog's case, there are some joint ventures which are overseas and is calculated in terms of US dollar. So because ringgit has depreciated, so balance sheet and ratios and gauges. Now most important is the current ratio, which is measured as the current assets divided by the current liabilities. The debt to equity ratio, total liabilities divided by total equity, and gearing ratio. Gearing ratio is normally calculated for REITs. For companies, it is good enough to use a debt to equity ratio. Okay, but in case for REITs, it is actually total liabilities divided by total assets. So, so the other thing which we want to know is the net asset per share value, or the net asset per share, okay, which is the total equity divided by the total number of shares in circulation. Now, this one would give you actually the book value per share. Okay, net asset value per share is actually the book value per share. Okay, so that's why when we use this, okay, we will know what is the actual book value per share so that we can measure it against the share price. Now let's look at analyzing Dialog's balance sheet. The current ratio is actually 2.25. Now, it's very important where a current ratio must have always be more than 1, because the total current assets must always be more than the current liabilities. Otherwise, if the current asset is less than the current liabilities, then the company's current commitment is not enough to meet, current asset is not enough to meet its current commitment. So that's why it must always be more than 1. And here, with a current ratio of 2.25, goes to show that Dialog is actually in a very comfortable position. Debt to equity ratio, okay, is 0.71. Okay. Now, debt to equity ratio measures the leverage of a company. The higher the ratio, the greater the leverage, and thus the risk level. Leverage means, borrowings, whether current and non-current. So that's why the higher the leverage means a company is borrowing more money. Okay, and this could be a danger if, let's say, in an environment where there's escalating interest rates. Okay, now Dialog's net asset value per share is 0.427. Okay, total equity is also known as net asset per value, and it is often referred to as the company's book value. Net asset value per share is thus the book value per share. Key takeaways from the balance sheet: we know that cash and equivalents, is 854 million, which is a very healthy cash position. Okay, trade receivables is more than trade payables. Now, if let's say trade payables is more than trade receivables, then it's worthwhile to find out in the balance sheet. Normally, they have certain indication why is it such. But if let's say a company is having, let's say, trade payables more than trade receivables, then it is not a very good position, especially if, let's say, you are evaluating a consumer goods company. Okay, so normally if a consumer goods company, if they have trade receivables that is less than trade payables, it means that, number one, they could have poor conversion of inventories into sales, and therefore it's not a very healthy position. You will also notice that Dialog's this is actually mitigated by decrease in short-term borrowings by 82.5% compared to 2014. So although long-term borrowings increased, but short-term borrowings actually fell even much more. So in that case, Dialog financial position is not that bad because short-term borrowings fell drastically, okay, despite long-term borrowings having a slight increase. Dialog as a company have increased its asset base, and therefore after deducting the total liabilities, there is still an increase in total equity. The net asset value per share increased by 7.3% compared to 2014. So these are very good indicators that the company is performing quite well. Now, one of the key issues is that a lot of companies do put into their summary of a financial report, things like debt to EBITDA. EBITDA means earnings before interest, depreciation, taxes, and amortization. Now, I'm not in favor of using debt to EBITDA as a calculation, because when you use debt to EBITDA, you take out those things that are important. For example, interest. When you have debt, there is interest payment to be made. So it cannot be that you exclude them. And when you make capital investment in plant and machinery and other equipment, there is bound to be depreciation. So when you take out all these costs, taxes, amortization, then it gives a very high figure for the earnings. And when you have debt divided by a higher figure, that debt to EBITDA figure will be very low. But if let's say you include all this in, especially if a company is very capital intensive, then the earnings after all this could be very low, and the debt then will be, debt to the earnings will actually be much higher. So when you focus too much on debt to EBITDA, it will give a wrong picture of the financial health of a company. And most important of all, I kind of like Warren Buffett's term when he questioned when companies uses debt to EBITDA as a financial measurement. He said this: does management think the tooth fairy pays for capital expenditures? Okay, so he is trying to tell people, your capital investment doesn't come free. There's cost to be made, and therefore it's very important for you to include depreciation. If you borrow money for capital investment, there is interest incurred. And ratios, important things like dividend yield. How you calculate dividend yield is annual dividend divided by a share price. Now, before you make a purchase, okay, you can actually look at the annual dividend and the current share price, and when you yield, so if that yield meets your appetite, okay, then you can buy. So once bought, okay, this will be, let's say your share price will be fixed based on your purchase price. The PE ratio is the share price divided by the earnings per share. Return on equity will be net profit divided by equity and times with 100% as a percentage. Payback period consists of non-current borrowings and annual net profit. Now, payback period is something that you don't find in financial measurement. This is my own use of that, because it is similar like debt to EBITDA. But this time, okay, I'm using it as annual net profit, not EBITDA. So when I have non-current borrowings divided by the annual net profit, it is like assuming numbers, total amount of long-term debt. That's why it's called a non-current borrowings. I would know what is the number of years that is required using the same amount of profit to pay off its entire debt. And this would actually give you some indication how many years it would require and whether it meets your investment profile or not. The other is the price to book value, which is the share price divided by the net asset value per share or the book value per share. So how we calculate it? Now, Dialog's dividend is 3 cents divided by its price, okay, of RM1.59 is just 1.9%. Disregard, the yield for Dialog is much lower. If you are buying a stock just for dividend yield, make sure that the dividend yield is higher than the okay. In this regard, Dialog is a growth company, therefore dividend yield is of lesser importance. So actually it depends also what you are looking for. If you are looking for dividend yield, then Dialog may not be the kind of company that suits your investment profile. And you may have to look for other companies that have a yield that exceeds your exceeds the FD rate and therefore meet your expectation. The price to earning ratio, okay, is 33.5. Now, for Q1, but I am expectant of what the whole year, okay, so that I know if Dialog were to maintain its current net profit, okay, and divided by the kind of share price that it is, okay, then I know that it is at 33.5, okay, a PE. Return on equity, You have also similar thing, okay, annual net profit of 250 million, okay, 180, and therefore I get a return equity of 11.1%. Okay, this is how we look at the payback period. Now, total Dialog's long-term borrowing amounted to 743 million. If I divided it by the estimated annual net profit of 250 million, it is 2.97 years. So which means if Dialog were to have its annual profit, touching 250 million, it can actually, without doing further investment and further borrowing, it can actually pay off its entire debt in less than 3 years. Okay, here the price to book value is 3.7 times. So what do we know from this analysis? Now, Dialog dividend yield is below the current FD rate. Decision to invest in the company should rest on its growth potential rather than its dividend yield, because Dialog is a growth company, right? Now, Dialog's PE ratio is high, but it warrants a closer look by comparing it with its peers in the industry. Now, sometimes when we invest, we hear people telling us, go for a company which PE ratio is very low, okay, preferably less than 15. Now, it does not necessarily mean that, you have to wait for that kind of PE ratio. Most importantly is, what is the industry, showing in terms of, the PE ratio. So when, if let's say the general industry is 15, but that company is showing a PE ratio of 33, yes, then the share for that company could be overvalued. But if let's say less than 15, some are more, then if let's say it is not consistent, then I would think that, it much depends on the company. It is worth buying into. Now, I would prefer to look at, measuring Dialog in terms of how many times it's trading at its book value. At 3.7 times its book value. Then, is it overvalued? Is it undervalued? Or is it fair value? So it much depends on how you set this. What is your limit? Some people would not buy. Okay, so always look at it, okay, priority in terms of your risk tolerance. Now, very importantly, each of us have varying tolerance for risk. It is important that we set indicators comes into play. Now, why is KPI important? KPIs help you to separate the good companies from the bad. Okay. Number 2, KPIs provide you with a quantitative methodology in analyzing companies. It is first and foremost a risk management tool. For the tool to be successful, you must abide by the rules you set. Now, a lot of us invest, often follow by what analysts say, or sometimes based on sentiment, but if you do not have something, a risk management tool to really help you in your assessment, what you are likely to go into is going into a trade that multiply your risk, okay, because that company might not meet your risk tolerance because it could have failed the KPIs that you have set. Okay, so that's why KPIs is very important, because it helps you define what is your tolerance for risk. Now, how to set your KPIs? Always set in against the prevailing economic conditions. Once set, you cannot change the KPI unless the economic conditions have changed. Therefore, your previous KPI would be redundant in the new economic environment. Now, what are the important KPIs? These are based on my own tolerance. Fixed rule that you must follow all these percentages. Okay, but in my list of KPI, if let's say when I measure revenue growth in the growing economy, my revenue growth expectation likewise would drop, and must be more than 15%. In a slowing growth is 10%. Now, why is it that revenue growth is much lower than profit growth? Because when it comes to have a lot of ways and a lot of issues which they managing expenses, okay, managing financing costs, reducing borrowings and such. So that's why I have a higher KPI set for net profit growth versus revenue growth. Now the current ratio, non-capital intensive industry should be more than 1.5 times. Current ratio for capital intensive, less than 1 time. Now the reason is that capital intensive industry needs to borrow more money, and therefore payments like interest on borrowings for current debts would be higher, and therefore I actually lower the benchmark. Debt to equity ratio, non-capital intensive industry must be more than 1. Debt to equity ratio, must be less than 1. For capital intensive, must be less than 1.5. Dividend yield must be more than 4% because that's roughly our current FD rate. The payback period must be less than 5 years. Now, why I say 5 years? Normally, if we invest in a company that has tremendous debt, okay, which takes, let's say, more than 10 years or even 20 years to pay off, then you are investing with a company that have greater uncertainty, because to really pay off its entire debt, it takes about 10 to 20 years. Within that time, a lot of things could have happened, and economic cycle would have run a few times over, because normal economic cycle is around 7 years between a recession and a growth. Now, if let's say the company takes about 20 years to pay off its entire debt based on the current net profit, can you imagine how many cycles there is? Then whether the survivability of the company, can even go is a question, because we don't know whether a company can survive after the next 2 or 3 cycles. So that's why always look at a payback period that is within a short to medium term, and 5 years is the best gauge. But of course, if you are a greater risk taker, you can say that I'm looking at 10 years. There's no harm. I am not a very high risk taker, and therefore I want to have a very balanced portfolio. The price to book value ratio must be less than 3 times, which means I'm in 3 times its book value per share. Okay. Now in Dialog's case, it is actually 3.7. So I may not, okay, invest in Dialog, okay, despite some of the better indicators. But how does Dialog actually measure when, compared to KPI first? Revenue growth minus 0.96%. Therefore, it is actually less than the KPI. We have a no here. We have a yes here, meeting a KPI. Okay. Current ratio, which is 2.25. Yes. because it exceeds 1. Debt to equity ratio 0.71, yes, because it's below 1. It's not more than 4%. Payback period 2.97%, yes, because it's less than 5 years. Now price to a KPI with a scorecard, and this is HR department often have KPIs also to measure how an executive performs. KPI set, okay, whether they have exceeded such KPI, and then what after calculating everything, in the case of evaluating companies, okay, you must have a to really help you determine to go ahead or not to go ahead with your investment, okay. But over here, you can see that I did not okay. Some industries may have a return on equity that is very different compared to peers. Dialogue with Sapura Kencana. Okay, we have the KPIs here. Okay, and now I'm comparing Dialogue with Sapura Kencana. Now revenue growth, Dialogue is a no, but Sapura Kencana is a yes. Okay, their revenue growth definitely exceed more than 5%. Net profit growth, okay, whether they exceed 10%, for Dialogue is a yes, Sapura is a no. The current ratio, okay, current ratio is already show, a concern because Sapura Kencana its current commitments. Now, when a company does not have enough current assets to meet, later would be the company borrowing from the debt market, okay, to pay off certain debts that are due in the current period. This would become due inside a year, okay? And if let's say as the year runs out, the financial year runs out, and there are certain current liabilities would have to borrow from the debt market to pay off. And this means that it will incur a debt to equity ratio. But in this case, okay, both companies dividend yield, both do not meet that criteria. Payback period, now Dialogue can pay less than 5 years, but Sapura Kencana is not able to do so. So from here, you require more than 5 years, and therefore will increase the risk somewhat. Price to book value ratio, okay, less than 3 times. For Dialogue is a no, but Sapura Kencana is 33.5, whereas Sapura Kencana is 16.3. Return on equity, 11.1%. About Dialogue having a scorecard. Now, when we start comparing tricks, okay, because you can add a few more companies here, and you see how many numbers of yes and no, okay, and another figure here to help you gauge which one actually outperform from the rest, and therefore that one that outperformed the rest would be the best indicator, okay, of your investment choice. So key takeaways from the analysis. For Sakura Kencana, 3 yes and 4 no. But most importantly, Dialog scored yes where it matters to oil, current ratio, and the payback period. Dialog also scored better in return on equity. So in this regard, I will select Dialog over Sakura Kencana. Okay, but Dialog's price is slightly above our KPI set for the price to book value ratio, and therefore I will not buy but monitor the share. So in this case, but I do not want to buy, okay, on on a price that exceeds my limit on the how many times of the book value. Okay, therefore I will monitor for opportunity for Dialog share price to fall below 3 times the book value, and then I will buy. Okay, so in this case, the price to book value ratio takes precedence over the PE in this regard. Okay, because most growth companies Dialog's price fall below the 3 times book value, okay, most likely the PE would not be 33.5. It could be 20 something when it moves into that area. So likewise, that's why I say that if you have a price to book value ratio, okay, that will also, if the share moves below that, okay, that will also correspondingly result in a PE that would likewise lower itself. So this is how you look at, from analyzing a company's income KPIs, and then building up a scorecard for a company against so many peers, and this is likely the best company based on the methodology certain things, there is a secondary support document, okay, in the quarterly report called the cash flow statement. Now, if let's say I would only fall back company exhibit very poor profit growth, okay, because if let's say the profit go back so much on the cash flow statement, but you can always look back on the cash flow statement as a secondary source and look at the operating cash flow. If let's say there's a positive operating cash flow, then that would lend support to your assessment.
Okay, we have come to the question and answer sessions. Hello, can you guys hear me?
Yep, can.
All right. So PC, I'm going to post to you the first questions, but we have a few questions coming in already. But anyway, you guys can type in your questions. But in the meantime, let's do something fun. Let's launch a poll. Okay, hang on. So yeah, while you're typing for your questions, let's do a poll. So where do you think KLCI will go tomorrow? Pick one. Okay, we have 83% of you voted, 85% of you voted, 88% of you voted. Let's wait for 13 seconds more. %93 voted. Where's the last one or two guy who haven't voted? Are you online? Okay, I can't wait any further, but alright, I would want to show you the poll result. Wait, hang on. So I'll close the poll now. And then let me share with the result. So this is the result. Do you see it? That 34% of you think that it will up more than 10 points tomorrow. 39% of you feel that it will down more than 10 points tomorrow. And 26% feel that it would cover in between 20 points tomorrow. Okay, those who pick up more than 10 points tomorrow, maybe you have benchmarked the Shanghai stock index go up today. All right. So anyway, thank you so much for your participation in this poll, just to check whether you are still online or not. All right, so let me hang on. Let me close the poll now. So okay, we have ample time for you to type up your questions. So let's go to the first questions by Mr. Lo Seong Kim. Hi, I have a question on your analysis on income statement. Do you consider the impact of currency exchange on the profit for those international company? Thanks.
I think when we are in an environment whereby the ringgit, okay, has depreciated in terms of the US dollar, it's actually a plus point when convert back into ringgit. So essentially, yes, if companies have income source in US dollar, it can offset the depreciation in ringgit, where revenue can actually be more. So these companies would rate favorably. But always, again, have revenue is one side. You need to consider the profitability. Some companies may have external revenue source that is outside of this country, but if let's say it's poorly managed, they may still not be able to deliver that kind of profit growth that you expect.
Okay, so the next question is, I have another question on the number of shares. From what I know, most of the financial reports provide weighted number of shares or maybe number of diluted shares. How would you recommend us to calculate the number of shares?
Normally sometimes in a quarterly statement, okay, there are some number of shares that is being printed out. Sometimes there are actually net asset value per share that they will actually print out in the quarterly report as well. Now, only when a company did not state, okay, its net asset value per share, then you may need to find out what is the amount of share, okay, that you need to divide from the total equity. In this regard, okay, always look at the number of shares that are listed, okay. Sometimes they put earnings that after certain dilution, that is actually slight reduction. I normally look at the comprehensive net income, okay, the net profit. I wouldn't go into diluted because that amount normally is very, very little, and sometimes there's no, it's just a very small percentages in terms of the whole amount, okay. But in the earnings per share, it's not so much impact because it's actually point some. Okay, next question.
Okay, so the next question is, does ROE means high profitability, and which sectors offer higher ROE, return on equity?
I think whatever that you look at, okay, some sectors like people put banks could be higher, say definitely in the 15% ROE, but it's a different industry. May or may not result in you missing some other opportunities. So always look at it, compare it to peers would actually give you a better indication. Okay, some companies may have let's say ROA that is so much. Okay, but then also likewise they have a high debt, okay, high level of debt. Your total equity could be total equity, therefore you get a higher figure. So that's why you cannot just base on the ROE to do a selection. You have to look at the entire income statement and the balance sheet. Now, investment, when it comes to fundamental analysis, there's always no short. 20% ROE because their total equity is so small, because their total liabilities is even bigger. You get what I mean? So unless you look at the balance sheet, then you know whether the debt level are acceptable. A true undervalued company. Okay.
Okay, so the next question is, when we use KPI matrix, we should measure with year on year or quarter on quarterly basis, or how should it be?
Okay. Normally, I would look at on a year-to-year basis. Okay, because what I'm interested in is, what are the prospects. Yeah. Then you can also go into quarter and quarter because why I use if let's say I look at certain quarter, there's a major write-off, then I will also be interested a company on the average. Okay, let's say some quarters are good, some quarters are bad. How did that company perform? How the company perform? Because some quarters could be good, some quarters could be bad, and some quarters could be lagging before certain things happen. So quarter to quarter, yes, read it. Okay, you must know quarter to quarter also to a certain extent why there are certain things that behave. Based in, to average out the whole thing, okay, for that whole year, so that it can industry, quarter and quarter wouldn't tell you much. Therefore, year to date would tell you a much better story.
Okay. So next question would be, where should I find the peers company during a KPI comparison? Like those famous yes lah, but such as examples given dialogue and Sapra Pranchana. So how?
Actually, before you want to start investing in a company, you have to ask yourself why you want to select a particular industry. Okay, is it because the industry is doing well, or is it because someone say buy this company? So if you know which industry you are keen at, there's a lot of things you can do. Like Bursa, okay, you can actually search within certain category. Construction, there are a few. Also include, of course, some of them could be, trading and services that could be different. like for example, Air Asia. You cannot compare Air Asia, let's say, let's say one is in transport, the other is in consumer goods. So then Air Asia with another transport, but I think Air Asia is the last time you have mass, then actually you can actually compare the two. Okay, so it as peers. So look at the industry. If let's say it's not and do a Google search and list those companies in that particular industry, I'm sure you can find those as well, because there are various type of information available online.
So how long do we need to review the KPI matrix, like recommend time frame? This is the next questions.
Okay. Now, all of us know that the current economy is really not good. Okay, it's actually slowing, and therefore, until the period where you will see that I only changed the net profit growth and also the revenue growth, because essentially those in the is quite fixed, because no matter what, current assets must be enough to offset current liabilities. You cannot say that because economy is growing, therefore I would reduce it less than 1. Okay, so certain things are pretty fixed. Okay, it's just that, okay, economy is growing higher, but you want to, let's say, just focus on the profit. Start growing much faster. Okay, you can change your KPI, from would be rising very fast. Okay, so you want to have better measure of safety. Yes, you can do that. Okay, but essentially, why I use that KPI, because I have economy in terms of other ratios. Okay, but for profit and revenue growth, 1, 2. Okay, next question.
So what is your opinion on the impact of value cap? That is the next question.
Value cap objective is to support the stock market, no doubt. Okay, but how much can the support be? Because it means the burnout rate of funding, okay, will be much higher. And support not fully, because when there's certain fall further down, they would decline, then they will pump in all the money altogether, because it's still a kind of public funds, okay, which they need. Sometimes do not, if let's say the economy is not, the whole global economy all over the major developed economies. In Europe, this year they are talking that Europe might disintegrate, okay, because a lot of countries don't see eye to eye already. Okay, in US, heavily indebted, Japan heavily indebted, China heavily indebted. So when you have so many of those developed countries being heavily indebted, they are also forecasting that their own stock markets would tend to drop. So that's why you see foreigners, exiting, okay, from let's say emerging markets, okay, so that they want to retain cash, so that when the other developed markets drop, they have the cash to buy into it. So that's why value cap is just one portion of support, but without extensive foreign buying, okay, there could be some limited progress. So I think in an economy where, in a stock market where it is falling, you need not, you need not go into a situation whereby I will avoid it totally, because sometimes it is when opportunity abounds also. So that's why you need to be very selective. Watch out for certain price movement that would make certain stock a steal, okay? And when sometimes you have to embrace it, okay, rather than being fearful and avoid it. But that doesn't mean that you also, like value cap, you keep on buying, You don't buy in anticipation of value cap. You buy in anticipation that you manage to select a stock that is undervalued based on the current circumstance, so that when the economy recovers, you see a few multi comes and support. Okay, you just make that small percentage of gain. You see, if of challenge and find the best undervalued company, hold it, okay, and wait until the economy grow, you will realize better percentages. Now, just to share with you an example, during 2008, Carlsberg dropped, I think, at one time to 3 ringgit and 42 or 62 cents. But actually went up around 13 or 14 ringgit. Can you see the difference? It doesn't mean that you buy in 2008 when it's 3 ringgit and 42 cents or 62 cents, and then when it reach 4 ringgit, you sell, which is around somewhere around 2009, 2010. So you wait for it to grow and grow and grow and grow, so that your profit becomes multiples rather than when it comes to value investing. Okay, don't look at just EPS. You're looking at value investing. That's when the time you actually embrace the kind of challenge ahead. Regardless whether there's other kind of whether value cap is in or EPS. Exit and make a few multiples. Okay.
Okay, so the next question would be, what is the impact of China's economy on Malaysian economy?
I think one of the key things about China's economy is that looking to devalue the yuan or renminbi. Okay, if China devalues and currency likewise could see a lot of Asia currencies even the US dollar will be greatly challenged, okay, because not aware, the total debt to GDP in US is 300 and more than 300. Okay? So that's why at some point in time, the US economy cannot be printing money, okay, or cannot be selling debt, because it means QE4 could be coming in with with negative interest rate. Okay, if the US economy continues to trend down, now then the US dollar would fall. So that is why in this first half of the year, a lot of uncertainties would be around the euro, the yen, the US dollar, and the China's renminbi. Okay, we may see some strength in the US dollar. We can expect that the US will come in with a lot of loose policy. dollar would drop. And when that happened, ringgit would actually trend higher. But not only that, because if the US dollar does weaken, commodities price would actually move up. So then that would be the oil-related stocks. Okay, this is a scenario that could happen. Understanding of what could happen doesn't mean that it must happen. Okay, so do take it with a pinch of salt. Okay, I am not that 100% accurate, but the trends are there that I'm sharing with you. Okay, first half, yes, ringgit will renminbi. Okay.
Okay, so the next
Next
question
question.
would be, is it good to consider to invest in REITs?
Play, yeah. But not forgetting that shopping REITs currently, those in the shopping mall business, will be under some pressure. Okay, now that could impact some of the shopping mall REITs. If you are into REITs, go for those that are hybrid. Okay, which means they maybe have one or two. Not from a singular class of asset. Okay, there's multiple class of asset which they can derive income. Now, REITs would be ideal for the defensive play because 90% of their net income must be passed back onto the unit holder, and they are also regulated in that their borrowing costs cannot exceed 50% in terms of gearing. So that is why it offers some level of protection. But even for that, REITs, okay, you have to be quite selective. Select those that are backed by. Okay.
Okay, so what will you use to compare growth? Is it corresponding quarters or successive quarters?
I think the most important thing is that where the dynamics of technology and policy can now some let's say technology that is applicable to back to many quarters, it tells you a story but may not apply to current. So when you look at certain financial data, okay, indication that, okay, few things. The total equity have actually enlarged, has actually grown a bit, okay, to show that the company is actually, building up a very healthy asset base, okay. I will also look at, always I would tend to look at, cash at hand because in times of poor economy, that's when this company would actually be able to acquire cheap assets, okay, like a fire sale, okay. So look back only with an understanding, but do not use that as a gauge to determine the future because when it comes to technology, especially because technology that is applicable previously is no longer applicable nowadays, okay. Just like in terms of consumer brands, okay, consumer brands that were good last time, okay, doesn't mean that this time, is just as popular. So sometimes when you look back, a company may exhibit, a downtrend, but it also means that if let's say after the downtrend, there's a slight trend that is the most recent one, then I would bet on the slight trend that is most recent one. I wouldn't bet that previously they were so high, now it's still very low, and therefore I'm not keen to buy. Because any movement out of a low trending environment is an indication that it is finally moving from a poor environment to a better environment. So I would rather base on that rather than based on 5 years ago. Okay.
Okay. So the next question would be, if you want to interpret a company's financial statement, how many years do we use? 5 years, 10 years, or 2 years?
I think normally I use 5 years as a reading material just to understand whether the company has gained in terms of revenue. But to really measure, I would just measure it against last year. Okay, I wouldn't measure it over the past 5 years, because what is the past 5 years is already history. What is important is what is trending since last year, okay, and how is it moving based on last year's result, how is it moving towards the future, okay. Use the 5-year period as something that, okay, you read to understand where the direction of the company, but to measure and to gauge whether this company is, have the potential to go up or go down, okay, you have to base it on the nearest year, which is the previous year. This is my own experience, okay. Of course, it doesn't stop. It doesn't mean that you are wrong if you want to go back to 5 years, okay. So if you want to gauge the fastest way, okay, is to look at a company's, okay, balance sheet first, because if that more than if the company's debt is very high, okay, you no need to look at the revenue, okay, you can straight away discard that company, because that is the most recent. Previous 5 years may not have enough, the debt level may be very low, okay, but if the last year the debt has increased, and this year debt has increased versus last year, then that will help me decide whether this company is worthwhile investing or not. Okay, if you want a very good shortcut, look at the balance sheet. Okay, if let's say the debt to equity, current ratio, all those doesn't meet the kind of KPI, you can forget about the company totally. Okay, that's the fastest way.
So balance sheet is very important now.
At least the balance sheet help you to ensure the survivability of the company.
Yeah. Okay, so the next question would be, is it good also to invest in warrants of a particular company?
I being a less warrants sometimes to people is very ideal for trading, okay, not as a source of a long period, okay, to realize gain, okay. But if you are doing trading, yes, warrant could be ideal. But if let's say you are talking about value investing, then warrant to me is totally out of the picture, because it wouldn't outlive what intention I have for the stock to grow, maybe 3 years or 5 years, So warrants good for trading, okay. I wouldn't term that it's good for investment, because it's something that you want to make money fast, because after a certain period, its value tend to drop.
Okay, so it's only for trading, not investment. So the next question would be, hang on. The next question would be, are there any available free software online that we can use to filter the properties of the KPIs that you just presented?
Now, this KPI methodology, you don't see it in other books or whatsoever. Now, I use it because it's based on my understanding that, first of all, before investing, you must know how to manage your risk. Therefore, the KPI is a risk investment tool. There's no such software, okay, as far as I know, because I wrote it first in my first book, okay, which I dare put the KPI because it's based on my experience, okay. So that's why there's no such software. This is wholly my own adaptation based on my tolerance for risk.
Okay, so is the KPI methodology applicable to a foreign share too?
Yes, if you can understand the methodology, you can actually compare. For example, you want to compare among the banks, foreign banks, you can compare HSBC, Citibank, and all that, and see who has a kind of profile that meets your risk tolerance. You can apply it to any type of investment, whether in Malaysia, Singapore, Hong Kong, or elsewhere. Okay, because it's something that you set the rules by, okay, in order to dictate your choice of investment. Okay, it doesn't stop where it is.
Okay. So the question next is there any huge impact on Malaysian economy as a result of the increase of US interest rate?
Definitely there is. Okay. Although I doubt that the US would continuously increase interest rate this year because the US economy is certainly very bad shape right now. But assuming they do, now it can really affect, okay, Malaysia on a few fronts. Number one, if interest rate increase, value of US dollar would also increase, and therefore ringgit would depreciate against the US dollar. That's number one. Secondly, if US increase interest rate, okay, there will be a shift of funds from other countries into the US economy. Now, if that happens, okay, for example, if let's say ringgit is shifted towards foreign assets, then the ringgit would weaken some more. And therefore, in order to stop that, okay, Bank Negara would likely increase interest rate as well, so that it stops the flow of our currency into US dollars base. So that's why if Bank Negara increase interest rate, then a lot of stocks, such as those in the property stocks, would be hit. Okay, although the banks might perform better because mortgage rates and higher interest and all those would be normally positive for banks. Okay, but the industry manufacturing which borrow money from banks, okay, for capital investment, those would be badly hit. And that is why normally after increasing interest rates, okay, continuous increase in interest rate, you will tend to see a recession forming. Okay, so that is why that is how the increase in interest rate in US would impact Malaysia.
Okay, it's a very great insight into economy. So next question would be, is it recommended to buy IPO shares?
Always study the financial statement. Okay, always look at the debt to be IPO. Okay, look at it. How are many years ago, in the 1990s, people used to say IPO, just bid for it because definitely will go up one. Nowadays, no longer, some IPOs would fall flat. It may go up, but no longer like previously. 20-30%, then afterward they start falling back below the IPO price even. So that is why when you invest in an IPO, okay, which it from the others. Okay, if let's say that IPO have very, very good balance sheet, okay, current ratio looks good, then okay, better than the peers, then yes, okay, because you cannot just is something that is that must be financially driven. Okay, everything hope. Okay, then it is like in the number forecasting. It is a hope industry already. Okay, but investment is something like you must do your own due diligence, and if let's say it meets up, then yes, you can go ahead. Okay, otherwise, there are some IPOs which actually, after a run, they are now below IPO price as well. Some even after a few years become PN 14.
Okay. So yeah, it's 10 o'clock now, but I still have questions on my screen. So yeah, we will just stop at the questions now, so you don't write in any more questions because it has been a little bit late. So in the meantime, we will try to finish as many questions as we have on the screen now. So the next question will be: since the property outlook is not that good in this year due to lower demand, will it affect the REITs?
I think REITs and property are very much different here. Okay. Now, properties, if demand is poor, will affect those property developer. REITs don't develop property and sell. Okay, they manage properties. Okay, which means the property is already a hard asset. Okay, it is still not under, let's say, construction or whatsoever, that, and they don't have funding to actually complete the construction of that building. No, REITs are actually investment into hard assets that can immediately start a recurring income. So that is why REITs are differentiated from property developers. Now, in my Bursa REITs talk recently, I share with 4 are actually REITs. Okay, so that's already hard assets with recurring income. Okay, next question.
Okay, in your opinion, how many percentage of profit you foresee to earn until you choose to sell the share?
I think it much depends. 20% is okay, 30% is okay, but let me share with you my method. I would, let's say, have 20% on a share profit expectation, but when the quarterly report comes out, I will read it. Okay, if let's say it shows a very, very good picture, I will increase my price target from 20% profit to maybe 30 or 40% target. Okay, that is how if you want to make money from the stock market, you must read the quarterly report.
Okay.
Evaluating. Yeah.
Okay. So next question is your favorite
Next.
questions. So is your latest book available in main bookstore like MPH Popular? What's the title of the book?
It's only available in Popular.
Okay. The title of the book, as I described, is the Invest in Foreign Shares and Invest in REITs. Okay, so these are
Yeah,
two books
both
that,
both books are, yeah.
yeah, you see, so you must buy. All right. The next question will be, second last question will be: the KPI metrics can be applied to REITs and stock options? Question mark. Or is there any formula used specifically to evaluate REITs?
It's the same. It's the same. But for REITs, you need to look at the gearing ratio, or current liabilities and non-current liabilities. You just look at the total borrowings divided by the total asset. That would give you the gearing ratio, because the gearing ratio is important because it's regulated, cannot exceed 50%. So you want to know that whether that REIT is exceeding or below 50%.
Okay. So last questions.
Okay.
Will you use the same fundamental analysis methodology in other companies such as private company or startup company?
You can use the same methodology in startup and all those, because it basically translates back to whether a company can survive during a period of crisis, whether a company can have the cash flow to cover its current liabilities. So it doesn't matter. You cannot say that this is just for let's say public listed company. If you are running a private enterprise, and if you want to adopt this kind of methodology, it's just that you know what is your tolerance for the risk within the company that you own. Okay, then you can set it and you measure it against. It doesn't mean that it's only applicable to a public listed company. Yeah.
Okay. All right. That's all for today. We have come to the end.
Okay.
We spent about an hour plus for the content and another 35 minutes for the Q&A. We have very interesting questions coming from all of you today. Thank you so much. So, PC can move to the next slide.
Okay.
Your
Hold on. Okay. So if there's, you can write to my email, okay, over here. And thank you so much for listening. And hope
yeah.
you all would have a nice investment opportunity in the coming weeks.
Oh, okay. So yeah, tomorrow we will have a brand new day and we will see whether you're right, whether the market will go up by 10 points, go down 10 points, or hover in between the 20 points.
Mm.
So as for now, thank you so much for coming, and this Bursa Young Investor Club webinar is made possible by Bursa Malaysia. Thank you, Bursa, for organizing it, and have a pleasant rest of your days. Thank you.
Okay. Good night.
Good night.